Alright, what's up guys? Welcome back to my channel. My name is Chviek and this is episode 2. And today we're going to talk about DeFi. What is DeFi and cryptocurrency? So DeFi is decentralized finance, where there's no central authority over currency, whereas banks are a central authority over currency. They can allow you to not have a bank account, they can hold your funds, and they can stop you from borrowing, all while having, ridiculously expensive fees, and DeFi is the alternative to this. So what is DeFi? DeFi is a code that runs as a bank. It is open to anyone, so where you can read all transactions, so there's no trust issues. It's censorship proof, so it has immutability. You have freedom to transact, and there's freedom from confiscation. So no funds are being held. You're allowed to transact, and you're allowed to borrow. And then, all the fees that are conducted with this are a lot less, and the time is a lot less as well. So there's 3 things that DeFi is really built on. It's cryptography, blockchain, and smart contracts. And then there's 5 components to DeFi. And the first one I want to start with is stablecoins. What are stablecoins? Their name is directly related to the price being targeted or pegged to the US dollar, and it's a reliable way to buy and sell coins without having to buy and sell. Instead, we can trade. So an example of this is you purchase some Ethereum, it goes up in price, you move it to Coinbase, and then from Coinbase you move it to your bank account, and then Ethereum goes down, and you take that money from your bank account, you put it into Coinbase, and then you purchase some more Ethereum. During this process, there's several days that have passed. You've paid several fees, and in addition to that, you'll have to report your capital gains on that. If you were to use a stable coin, you could have your Ethereum, it goes up in price, you move it over to your stable coin, Ethereum goes down, you take your stable coin, you move it over to Ethereum, and then in that time frame, it was, very limited. The fees were very minimal, and you wouldn't have to report your capital gains. So that's part 1 of DeFi. Part 2 is borrowing and lending through smart contracts. We have companies like Aave and Compound. They allow investors to deposit their coins and have borrowers borrow those coins plus an interest rate. And the smart contract will allow the funds to be used but also held at the same time. So with an addition to that, I want to mention that the borrower has to over-collateralize in order for the smart contract to pay back the investor plus the interest rate. So it can be a little puzzling there. So an example of that is, say you have 10 Ethereum, they're priced at $100, and you put it on something like Aave or Compound. It's worth, $1,000, but you're only able to play with $800 of a stable coin. And say you're doing this because you got interested in trading and you think you can make 3-4% a day. So you play with that for a while and you come to the conclusion that it's not really for you. So you have $800, and there's 2 scenarios with that. You can say, you did make some money, you just pay back the $800, you get your 10 Ethereum back. Say maybe you lost some money, then you would have 2 options here, and the 2 options are take what you have and run, or take what you have and pay back the difference for that $800 loan and get back your 10 Ethereum. And then the fun part of it is Ethereum goes up, take back those 10 coins, you got to play around and you still made money. So to wrap that up, it's just you're taking a loan out on your cryptocurrency. And then third one, going to decentralized exchange. Decentralized exchange allow for coins and tokens to be traded for coins and tokens for very minimal fees. It's where investors can pull money together, and then traders can trade with that, and the fees off those trades is what the investors get back. And then DEXs, or decentralized exchanges, they just open up the world for so many more possibilities in terms of like tokens and coins. We have things like PancakeSwap and Uniswap that have thousands of tokens with billions of dollars that are locked up in liquidity pools that people are trading and trading with. So yeah. And then the fourth one is insurance. So with insurance, this one's a little difficult, but recently where I'm located, a hurricane occurred, so I wanted to try to make it the easiest to where I could explain it. So you live in a coastal area, you have a $500 a month policy, and to start that policy, it would be a $5,000 startup payment. There would be AI that in that contract that would predict a premium for you, determining floods, natural disasters, whatever it may be, and then they'll provide you with a premium. And in that contract, you can determine what like payouts would be and such, and what the rules for that would be. And in that smart contract, there would be something that's called an oracle. This is very hard to explain. I'm going to make another video on it, but what it more or less is real world data being plugged into a smart contract. So say you live in that coastal area, a hurricane strikes the area, there's 24 inches, 3 feet of flooding, the winds were over 125 miles per hour. The real world data will be pumped into that contract, and say your premium states, if there's over 18 inches, provide this homeowner with X amount of dollars. Because of that hurricane, you would have code that would, provide you with your payout. You wouldn't have to, go and make the insurance claim and jump through hoops and call this person, and it would more or less be a great alternative for situations like that. And then the last one is margin trading. And margin trading, just to really explain that on a basic term, it's borrowing on margin from a bank would be, you put down a deposit and they'll give you X amount of dollars, and if that stock that you purchase with that money, it goes up, great, you pay off the loan, you take your money, you make money. But if in opposite regards you purchase the stock starts to go down, the bank will actually force you to sell that stock when you're not able to pay back that loan. So whatever the deposit is, say it's $1,000, you put in 200, stock goes down, it hits $800, they're forcing the sale. And so with crypto, it kind of makes this quicker, it's more open to anyone, and it's more secure, because last thing I didn't mention is, when you do want to margin trade, you have to have, quite a bit of money in the bank. You have to prove that you have, X amount of dollars. You have to verify your identity. For crypto, it's, I have my wallet, I can trade, I over collateralize, and it's on the blockchain. Everything's being watched. So yeah, the 5 pillars: stable coins, borrowing and lending, decentralized exchanges, insurance, and margin trading. And then just, kind of go right back. Just want to, before you depart, cryptography, blockchains, smart contracts. Guys, I'm really just working on my channel, trying to spit out information every week. I'll record the video. Right after the video, I move on to a new topic. I start studying the topic. I'll try to write up script, and I try to study it so I can spit this information out, and it's not like I'm just reading to you, but I'm really doing my best to try to relay the information to you guys so it's easier for you. So, if you have comments, if you think I missed anything, let me know. If you did like this, definitely like the video, that would be greatly appreciated. Yeah, I appreciate it, guys. Thanks. Have a great day. Your friend Brandon with Crypto.